Morning, everyone, and welcome to this AFMA and Reputex webinar on Australian carbon credits, the rise of a new asset class. In a few moments, I'll hand over to our presenter, Brett Harper, who is the Director of Research at Reputex, leading the electricity and carbon market research team. So today, Brett's going to run us through a Carbon Markets 101 as it relates to the Australian context and the Emissions Reduction Fund. Following that, he will provide an overview of supply and demand and price dynamics observed since commencement, and look at some of the implications to the market from policy developments both here and abroad. After the presentation, there will be time allocated for a Q&A session, so please feel free to send through questions in the Q&A panel to the side of your screen. And without further ado, over to you, Brett.
Thanks, Natalie. My name is Brett Harper. I'm the Director of Research at Reputex, and hopefully you can see the presentation here about Australian carbon credits, which are actually offsets in Australia. And we're going to be talking about the beginning of possibly a rise of a new asset class. Make sure, okay. Here's the things we're going to be going over. First of all, for those of you who may not be that familiar with the Australian carbon market, we're going to be doing an introduction to all of the market components, as well as the sources of demand. This is a very demand-driven market. Then we're going to be going through the Australian carbon price dynamics, including the Emissions Reduction Fund auction and the Australian carbon credit unit spot prices, before taking a look at perhaps the more exciting European context and what's driving European prices. And the question that we get asked most often these days is, could Australia do a Europe? Before leaving you with some key takeaways. So just a little bit about Reputex itself, for those who might not be that familiar with us. We're a leading provider of modeled services for the Australian electricity, renewable energy, and carbon emissions markets. We do market analysis and forecasts, as well as offset transaction support services and bespoke research advisory. We have over 150 customers across Australia and Asia Pacific, mostly amongst the high emitting companies, project developers, investors, and government policymakers. And those are split across 3 different segments. You can see some of our selected customers here from the corporate segments, developers and intermediaries, and in the government segments as well. So straight into what is the Australian carbon market and what are the key sources of ACCU offset demand. So first of all, the Australian carbon market consists of ACCUs, which are Australian carbon credit units. These are generated by projects. You can think of a tree planting project as one that could generate ACCUs. And the reason you generate these ACCUs is because of the buyers. So the first and most important buyer in the market is the government, Commonwealth Government's Emission Reduction Fund, often referred to as the ERF. This is a multi-billion-dollar government pool of funding that purchases abatement via forward contracts for fixed volume, fixed delivery ACCUs for up to 10 years. Over 200 million of these ACCUs have already been contracted, mainly from the land sector, at about 82% of the total ACCU contracting. Now, there's been a bit of a shift over the last year and a half. Now, the ERF primarily is for put options for the developers and effectively is serving as a floor price for ACCUs, giving the projects their bankable revenue to support new projects to be developed. Another source of demand that's often goes unnoticed, there is a compliance sector, and this revolves around the government's safeguard mechanism, which covers large emitting facilities over 100,000 tons of greenhouse gas emissions per facility per year. Add up all of these facilities together, and that consists of roughly about 30% of national emissions. These facilities are required to keep their net emissions below a limit, which the government calls a baseline, but there's flexibility in these baselines that allows most of these facilities to be able to increase their emissions without immediate accountability. And finally, the third source of demand for ACCUs is, small but growing very rapidly, is the voluntary demand. This mainly comes from companies with net zero emission pledges, usually towards some date in the future. It also comes from the Climate Active Carbon Neutrality Program, which can apply to individual products, as well as state governments that might be offsetting emissions for things like their vehicle fleets, perhaps in complement with transitioning to more electric vehicles. So those are our three main sources of demand for ACCUs. And here's a quick look at how each contributes to total demand under current policy. You can see the dark blue bars at the bottom there are the Emissions Reduction Fund. They currently make up around 85% of all demand, but that is forecast to be falling away as over the next several years as that fund is paid out. You can see those small gray slivers on the top. That's your compliance demand associated with the safeguard mechanism and the high emitting companies. That's less than 5% of total demand under the current policy settings. And then you have the yellow bars in the middle there. That's your voluntary demand, which I said is growing quite rapidly. Forecast to grow about 10x over the next decade, driven by those corporates and state governments. So you can see even though it's growing very rapidly, it makes up a minority of the market. And under current policy settings, it may not necessarily be enough to support continued growth in ACCU demand into the future. Let's take a closer look at that voluntary offset demand here, and we can see that voluntary offsetting is on the move this year. It is growing quite rapidly, and we've seen a 73% increase on the Q2 from last year. 4.5 million offsets have been voluntarily canceled, I think, as of last week for the second quarter of 2021. 97% of these are international offsets, mostly certified emission reductions, also known as CERs. And you can see those smaller green slivers on the top, that's the ACCUs at just 117,000 ACCUs being canceled, or about 3% of all cancellations this year. These ACCUs are actively underpinned, like I said, by the climate active carbon neutrality and the downstream product offsets associated with energy products, transport, and communications. So what about ACCUs with all those CERs? CERs are being favored, especially for the near-term carbon neutrality, and that's simply because they are cheap. They currently run from about 70 cents to $5, although they periodically dry up at the lower end of that range in terms of availability. But the bottom line is you can get about 10 CERs for every ACCU at the current prices. So that's why they're really being favored heavily by the market at the moment. ACCUs are really just too valuable to be used for immediate voluntary cancellation. ACCUs are much more valuable to be used towards future compliance risks, and therefore we see a lot of forward contracting activity for ACCUs over the next 3 to 10 years, as especially those high emitting companies shore up and hold on to their ACCU supply to make sure that's available. The main focus is really to hedge against future compliance risks and lock in low prices today as we expect prices to rise into the future. So now we're going to shift to talk more about the current price dynamics. Here, we're going to first look at the ERF auctions. These are the government auctions. We've recently seen auction prices of about $17 per ton, really failing to incentivize new supply for any type of fixed delivery. Almost all of the action, like I said before, is on the optional delivery with the kind of $16 prices serving as that price floor. But those ACCUs can then be sold to private entities that may offer a higher price into the future. In terms of the spot market, it's sitting at about $19 per ton this morning. That's up 15% from the beginning of the year. You can see our biggest price movement. The date I want you to remember is February 2nd. Happened to be a day the Prime Minister stated his support for net zero emissions, preferably happening by 2050. And that, amongst other reasons, which we'll discuss later, got the market a bit excited and launched us into this new price regime where spot prices have settled into a price regime since February, up between $18 and $19. So this is kind of the first step on a pathway towards net zero, but obviously there's a long ways to go. And there's even more talk of net zero emissions today, which may move the market again soon. For context, we should really keep in mind that local prices are well behind what's happening in Europe. The orange price on the bottom is the Australian price, whereas the blue line above are European Union allowances, or EUAs. They're up about 60% this year to about 81 Australian dollars per ton, and that's a 230% increase since the beginning of the pandemic. So the question, whenever I put this chart up, is could Australia carbon offset prices do a Europe? So an excellent question. Let's take a closer look at those EUA prices and what's driving them. We're going to here start from an index at the end of 2020. December 11th, EU leaders upgraded their 2030 climate target to be 55% below their baseline, which I believe is 1990 levels, to be better aligned with net zero by 2050. And the market quickly worked out that this is a fairly aggressive tightening of the ETS is required to make it fit for that new 55% target. So prices have to rise for the system to achieve that goal, and the market reacted, of course. Here, February 2nd, once again, 2021, EUAs saw investor participation jump in with 6.5% jump in the price after a Bloomberg article cited hedge funds buying EUAs in expectation of prices rising up towards 100 euros per ton. A little bit later in April, we saw more investor participation growing, more than doubling of the participants in the market, 300, and that really, created a bit of a fun fever hitting the EU ETS, with prices continuing to rise throughout that period. Now we're sitting around 50 euros per ton, and we've seen continued support for the ETS framework, legislator support for the market to reduce industry emissions and drive that least cost emissions reductions, with really nowhere to go but up from here as well. So could Australian carbon prices do a Europe in that sense of having skyrocketing prices? Of course, the answer is yes, but the EU ETS is the EU's key mechanism to reduce industry emissions. Some key differences are that it caps industry emissions, it aligns EU carbon ambition with a declining emissions cap, and it is used to create an economic incentive for the sectoral decarbonization, like fuel switching, away from coal and oil and gas towards renewables, and triggers investments in new technologies, especially with hydrogen, which is being pushed very hard in Europe. So it also has a very strong political support, even amongst the very diverse governments of the EU. Now, if we take a look at Australia, Australian carbon market is about 95% of a voluntary construct that includes the ERF, the speculators and the corporate actors, basically everyone except the compliance demand, which makes up less than 5% of the market, and actually has very limited political support, even if it has very widespread popular support amongst voters. The industry really does not yet face a robust emissions cap, and the national climate ambition is not yet linked to that cap. The carbon market is not yet viewed as an economic tool to trigger investments in clean technologies. That, of course, could change any day if the government changes its tune, but it certainly hasn't done so yet. So increased voluntary action is beginning to align the Australian carbon price with net zero emissions, seeing the writing on the wall and moving towards that position at some date in the future, but there's certainly no word from the federal government yet that we're going to be going in that direction. So now we're going to just have a look at our Reputex's forward expectations about what the impact of a net zero emissions will have on forward prices. This is a chart of safeguard emissions. Current industry emissions are really out of step with any sort of a net zero target. Previously, they've been about 24% above 2005 levels back in 2020, and they're forecast to go to 30% above 2005 levels in 2030. So really the wrong direction. However, industry is increasingly aware of the risk to emissions growth. the APRA climate transition and disclosure of risks. There's directors' duties and a lot of investor pressure with stakeholders and downstream products demanding cleaner products, as well as future compliance risks that could result from a policy change. So that corporate segment is really beginning to reach a tipping point when it comes to net zero. Just in case you haven't been reading any of the news headlines last month, we've seen investors and energy companies and utilities all moving in the same direction, having to pledge towards net zero and work out a way to get there. And of course, the specter of e-levies could impose a carbon price that's much higher than today's levels on Australian exports, especially if they're going to Europe, but also if they're perhaps going to the US or the UK, with even more climate tariffs being discussed. So the increased corporate demand for carbon offsets is really because of charts like this, where we see, despite in not being sure of the timing, the direction is clear. We're inevitably going to be going towards reaching net zero, and this, whether it's through a tighter safeguard policy mechanism with declining baselines, or just simply through voluntary actions, net zero targets are really supportive of increased ACCU demand from where we are today. If we were to start today versus 5 years from now, it makes a little bit of a difference in the trajectory, but essentially we're looking at about 5 million tons reduction per year from the high emitting companies. Interestingly, if we want to be more realistic, we're actually looking at the 2035 to 2045 timeframe for net zero being actually better aligned with a 1.5 to 2 degree target. But I think most of the market is still looking at 2050 at this point. So Australian prices today, the ERF is averaging about $16 a ton. Spot market is sitting at $19 a ton. And we see lots of forward activity in terms of kind of between $20 and $25 a ton over the next 3 years, and then options contracts above $25 a ton beyond that. So the Australian carbon market is already undergoing really a fundamental repricing on the prospect of net zero emissions, with significant price upside over the next decade, but also some real downside risk. This is Australia, and we've gotten excited about carbon policy before, only to see it not materialize. So further upside is certainly plausible with a national net zero target aligned with compliance rules, increased voluntary action as corporates shore up their supply and hedge compliance risks, as well as increased investor participation amongst all the various types of investors out there. So the key takeaways are really that the net zero activity is already beginning to impact the Australian market, even in the absence of federal government policy. More supportive policy would inevitably speed up our forward price curve, and we see companies using low-cost international offsets at the moment for immediate carbon neutrality, but also at the same time placing bets to lock in ACCU supply options to hedge against future compliance risks. There's growing interest from investors. In the short term, that means speculators and interest in carbon as a standalone asset class. And then in the longer term, which may be much more significant, is the use of carbon as a fundamental hedge for climate risk. For example, in equities, direct investments, energy commodities, even barrels of oil itself as a fundamental benchmark for investment. All of these are often climate linked, and you may need a hedge for inflation or just balancing out a well-balanced portfolio. We see lots of interest in carbon as an investment class. If you're interested in keeping up with all of this kind of spot price information, as well as our commentary on the carbon market, we do have an Energy IQ platform that you can access with the latest market data and forecasts among spot prices, price forecasts out to 2030, the associated fundamental supply and demand associated with that, all of our emissions projections going forward, and abatement costs for the entire Australian economy. as well as electricity prices if you're interested in that as well. But that's all I had for my presentation. Thank you very much for listening, and I'm certainly happy to answer any questions you guys may have on Australian carbon market.
Thanks, Brett. I'll just remind anyone, if you have any specific questions, please put those through in the Q&A. We don't have a great deal so far, but fortunately I have several questions that I can ask you, Brett, so there's no issues there. You did note that obviously in February, the shift in ACCU prices was quite evident when the Prime Minister did flag a support for a net zero target, preferably by 2050. Obviously, would we see, you know, if there is sort of any stronger signal from the federal government, or if there's a change in government policy or a new government, what are the likely impacts for the ACCU market?
Yeah, I think everyone realizes that we are going towards a net zero target. It's just a matter of when they're going to admit that and utter the words is a bit of a guessing game. So anytime, you know, the government, especially the Prime Minister, says anything along those lines, you'll probably see the market jump around. We've seen kind of bids in the low $18 this morning, lots of offers around $20. I think the market has set its bets that there won't be any major changes today with the renegotiation with the Nationals Party. It seems like they're not going to be moving towards net zero emissions today. But if that is different, or if that changes, you'd certainly see a jump in the spot market almost immediately, I would think.
Yeah, I think we'll just have to wait and see. I do have one question from a participant, which is in relation to CERs, or the certified emission reductions, and whether you have any comments around those, and I guess the fungibility with, I guess, ACCUs and other products.
Yes, certified emission reductions, or CERs, are associated with the Kyoto Protocol, was the kind of pre-Paris Agreement mechanism for negotiating emissions reductions. So the Kyoto Protocol has passed, and the future of CERs is really up in the air. Under the Paris Agreement, it hasn't yet been negotiated how those might play a role going forward. So I think that's why you see a lot of cancellations these days, as people anticipate this may be the last opportunity to use them for any sort of carbon neutrality going forward. They've been negotiating what to do with these types of CERs and other voluntary credits under the Paris Agreement for a long time. There's no indication that they're getting very close on coming to an agreement just yet. So there's a lot of uncertainty around CERs, especially in future years, which partially accounts for why they're so cheap and why they are often not relied on for any type of future liability that may be coming up. They can't be, you know, exchanged for ACCUs in any way. It's important to note, but they can be used under the Climate Active program. So you could use CERs, or you could use ACCUs, or some other voluntary units. So I guess there is some substitution there, though not directly.
I guess on a related note, we will probably see some, I guess, more on this following the COP26 in November in Glasgow, to see what happens with the rules under Article 6 of the Paris Agreement. So
yes, hopefully.
Yes. I have a few more questions. So the first one I'll go to is, what is the outlook for growth in new carbon credit assets here and internationally? And are you happy with the certification process around those credits?
Yeah, well, first of all, I think it's poised to do nothing but grow into the future. The market needs to grow a lot to be able to play a larger role in terms of providing that flexibility, because a lot of emissions that we have today can be reduced, but there's also a lot of kind of remainder emissions that we're not sure how to reduce with today's technology. And so those, you know, certainly if they're going to be offset into the future, perhaps in perpetuity, or perhaps with new technologies that come along, we really need to expand the kind of offset and carbon trading market quite a bit. So that is poised for growth. There, there are always refinements around the certification for carbon offsets and credits. Sometimes it has to do with the vintage date of when things are created, or the origin is very important. Um, some projects are much more attractive for their co-benefits and are priced accordingly. You could be protecting biodiversity, or cultural practices, or the Great Barrier Reef, or ancient rainforests, or helping indigenous rangers. All these type of things are seen as quite valuable co-benefits, with a price premium attached to that as well. So it depends, certainly in the voluntary market, where your credits come from in terms of what type of projects that are associated with it.
Mm-hmm. Okay, well, I have another question in the chat. So we have one question saying, are you seeing more demand for certain types of ACCUs over others? I assume this relates to the, I guess, the project base of the specific ACCUs.
Yeah, we are seeing changes in demand. The vegetation and tree planting projects are always very popular, and they really make up the bulk of ACCUs. So there's certainly a lot of demand there. I think it's a very tangible thing for people to understand. If you're planting trees, you're sequestering carbon, and that is seen as a direct offset for any emissions that you may have. Savanna burning is also very popular. This is where you have groups that go out and do early season burning across the Australian savanna, and that avoids a lot of late season emissions in terms of the landscape burning much hotter and with less control. And that really supports a lot of indigenous groups who may be doing that type of work on the ground. So those are very popular. And then also, I think soil carbon is becoming very popular. It's kind of a new project type in Australia, where farmers are paid often to do things like plant a more diverse mix of grasses that really kind of build up underground reservoirs of carbon in the soil itself, making the soil healthier and more productive. So those type of projects are certainly the most popular at the moment.
Mm-hmm. And I guess over time, depending on the abatement costs related to different projects, you might see more other projects being added to the eligibility criteria as well.
Mm-hmm.
I guess
Yep.
one of the key questions that I've been thinking about recently is, what are we going to see from the development of a carbon exchange? So we've noticed that the Clean Energy Regulator has released a tender in the last month or so, and so there are plans to, I guess, develop an exchange traded market for ACCUs. What are your expectations on how that will affect, I guess, the demand and supply of ACCUs? And obviously, will it also depend on whether there are other credits traded on that exchange, obviously other voluntary international credits and other products as well?
Yeah, I think they're still working out a lot of those questions about exactly what will be traded. But my understanding is that they intend it to be quite sophisticated, to have lots of different products on there, lots of different contract types. So it's probably a couple years away before we actually see an operating exchange, but I think that would really add to the confidence in the market and the liquidity, because right now, a lot of folks who are interested in ACCUs have trouble finding out where to get them, and they have trouble finding out exactly all of these steps they need to go through to acquire them, especially if you don't have an experienced kind of climate lawyer, or someone who knows how to negotiate these type of contracts. I think it would be much easier to have a exchange where things are more standardized and be able to buy, sell, and trade these type of products more automatically.
I guess we'll see what gets developed over the next year or so. I have another question, which is, how do ACCU prices affect wholesale energy prices?
That's an interesting question. I wouldn't say they affect them directly, but there is a bit of a link often with the large-scale generation certificates, which are for renewable energy
Mm.
and represent a megawatt hour of clean renewable energy. So some folks are looking at offsetting their emissions. They may have scope 2 emissions, which are generated through electricity use. And so oftentimes there are opportunities to choose between using LGCs, which are the renewable green certificates, versus ACCUs to directly offset the carbon associated with those emissions, depending on your calculations of your emissions intensity of your electricity use. Um, Other opportunities, um, you know, maybe to generate if you have like a medium scale solar project, and if you're building that over the next decade, you may want to evaluate whether it makes sense to generate LGCs or ACCUs. So there's lots of indirect connections there between
Mhm.
LGCs and ACCUs, and there will be probably price convergence over the next couple of years. But they are kind of fundamentally going in different directions, with LGCs going down in price and ACCUs going up in price.
Mhm. I guess tied to that as well is that the renewable energy target under which the LGCs are obviously created is slated to sort of end in 2030. So we might see something change depending on
Hmm.
what happens
Yeah, there
in the
is
coming years.
uncertainty beyond 2030 about what happens with LGCs.
Mm. Um, One more question. So given the popularity of certain methodologies and projects over others, are you seeing price differentials between certificates from different methodologies? I'm not sure if this was sort of answered earlier in terms of seeing the different demand.
Hmm. Yeah, absolutely. A lot of times the cheaper credits are usually associated with like methane reduction projects, whereas the more expensive credits are usually associated with things like savanna burning or diverse tree plantings or things like that. The the Land Restoration Fund in Queensland specifically tries to price in some of these additional co-benefits, allowing for higher prices associated with projects that are, I guess, associated with things that they're interested in, which is like protecting the Great Barrier Reef or supporting Indigenous communities.
Mhm. So we haven't gone into this yet, but I have a question. This is just one of my own questions. Obviously, after the King Review last year and the announcement in the federal budget earlier this year of the development of safeguard mechanism credits that will be distinct from ACCUs,
Mhm.
what is the likely demand, what is the impact on demand for ACCUs if a below baseline crediting mechanism comes into play? And would that only shift the compliance demand in the market?
Yes, potentially. It's all yet to be decided just yet. But every conversation usually revolves around ACCUs and SMCs, the safeguard mechanism credits, needing to be separate and not directly exchangeable, because there's concerns about disrupting the existing ACCU market, which is really just getting going. And you wouldn't want to oversupply the ACCU market with these other types of credits, which can be, potentially produced in very large volumes from the industrial emitting facilities themselves. On the other hand, I think there is quite a bit of concern about liquidity for ACCUs, especially if millions and millions and tons of offsets are needed. So the safeguard mechanism credits could continue to play a role there. Um, if they are going to be applied, it probably would be on the compliance demand side.
Mm-hmm.
Safeguard mechanism credits could potentially be generated by safeguard entities themselves for being below some, for lack of a better word, another baseline, some sort of transformative change that they undergo to reduce their own emissions. They could get credit for that and then sell those credits to another facility who may be above their emissions baseline and may need help there. So that could be a whole another trading regime that just exists on the compliance side amongst the safeguard emitters, which may or may not interact directly with the ACCU market.
Mm-hmm. And I guess that ties into the other question, which I sort of did flag earlier, in terms of if we see other voluntary markets scale up, and obviously then, I guess, attract Australian, I guess, demand, is there going to be a likely impact on then ACCU demand and then prices, and I guess long term, what will we see there?
Yeah, I mean, potentially, some folks are also interested in exporting ACCUs to even outside of Australia eventually, to folks who may want to, buy into our like CCS potential to
Hmm.
store carbon underground. So those are all things that are certainly being discussed. Carbon capture and storage is a new project type that is probably imminently going to be generating ACCUs soon. So there's, I think, a lot of interest even more generally in Australian type of offsets, anything to do with protecting the Great Barrier Reef or protecting koalas or other cute marsupials. There's a lot of interest in Australian projects, I think, from that perspective. Um, and the value is certainly there if those types of offsets could be used in external
Hmm.
markets. There's a lot of interest.
Hmm. I guess we'll just see things play out over the next coming months. So I guess one more question. So for someone who's new to offsetting and looking at a 10-year offset program of their emissions, obviously from a company, what are the options in terms of trying to manage price fluctuation from a buy or demand perspective?
Hmm. Well, if this is, the main thing is probably to look at where you can reduce emissions into the future. If you are going to take on any type of a net zero pledge, it's a very long-term commitment, and you want to be very aware of all the emissions reductions that could happen within your company to achieve that. And you probably want to get that squared away before you really look into offsets, because offsets are, forecast to become much more expensive, and you probably want to minimize your use of offsets into the future. Um, that being said, there are plenty of projects out there that are just waiting to get started, especially in Australia. We have a lot of potential in the land sector um, that a lot of other developed countries don't necessarily have. So there's plenty of potential projects and potential offsets just waiting to be to bought up. But it's all awaiting this policy uncertainty as well. That's why you see, beyond the 3 years, a lot of options to purchase those ACCUs if there's a real demand and a use for them into the future.
Well, it is very interesting. I think, yeah, because these markets are a policy construct, there's always going to be a lot of policy implications to the market from any change in signal from the government. So I think it's always a bit hard to predict. I have actually got another question. So before I let you go, if LGCs are convertible to carbon after adjustment for emissions intensity, what year do you forecast convergence between the two markets?
Probably sooner than most people expect. In the next couple of years, perhaps 23, 24. We've seen the rapid decarbonization of the NEM, certainly. Um, so we see LGC prices coming down. We see emissions intensity coming down. So those could converge with ACCUs quite quickly. And demand for ACCUs is really going nowhere but up. So LGCs or ACCUs could really serve as kind of a demand floor or a price floor for LGCs into the future. The conversion is a bit tricky depending on exactly what state you're in. May affect how you want to convert an LGC to an ACCU. You can think, for example, like a big wind project in Victoria, which is very dependent on brown coal, could have a much larger abatement or climate impact than the same wind project in Tasmania, which is powered by renewable energy. So that may or may not be a distinction that's made when converting from LGCs to ACCUs. These are all things that that still need to be worked out. So by default, we typically just use a NEM average emissions intensity, which probably sits near 0.7 kind of tons per megawatt hour right now, but is falling rapidly, you know, probably down to 0, certainly over the next 20 years.
All right, thanks, Brett. If we don't have any more questions, then I might bring this to a close, but thank you very much for coming today, providing your insights on the ACCU market as it stands and what might happen in the future. I hope everyone enjoyed this presentation and found it useful. If you have any further questions, please feel free to reach out to us, and we will distribute the slides to participants as well after the webinar. Thank you.
Thank you.
Thanks, Brett.
No problem.